Hi, welcome to Insurance Insider. This is Jeremy Hallett, bringing you a conversation today about key person life insurance. So, what is key person life insurance? Key person life insurance reimburses a business for an economic loss when an employee who is critical to the success of the business dies. Key employee life insurance is not a specific type of life insurance policy, but it's actually a way to use life insurance to offset a significant risk to a company. So the rationale behind this is a key employee, they may or may not be an owner, but a key employee has a few different traits. One of them, they're generally highly paid. They're responsible many times for management decisions. They can exert a significant impact on sales and or the operations of the business, and they can enjoy a special rapport with customers and creditors. So a business that suffers from this key employee's death does so in multiple ways. One of them is that loss of management skill or experience. Another one is the disruption in the sales or the production. Another one is missed business opportunities that would be coming their way because of the relationships this person had. Credit difficulties, such as the inability to make payments or a creditor's reluctance to extend credit because this individual is no longer at the company, and increased expenses associated with hiring and training, which may take years to train a replacement for this individual. So here's how it works. To get a key person life insurance policy, first, the business will notify the employee that it intends to purchase a specified amount of life insurance on the employee's life and then obtains that employee's written consent. It's always a positive. Actually, people enjoy that part of it. They know that they're valued. Two, this business then will apply for and actually is the owner and the beneficiary of the policy on the key employee's life. The business owns and is the Benny, which means they write the check and is the beneficiary of this policy. It goes to the business, not to that employee's family at death. Then one method for actually to determine the amount of that insurance is one way to do is called the contribution to earnings method. Under this method, what the business does is estimate the key employee's contribution to yearly profits and then multiplies that by the estimated number of years that employee would have worked. This result of that can be appropriately discounted to establish a basis for how much life insurance to purchase currently. Another method is the cost to replace experience method. So here the business takes the key person's compensation, subtracts the amount of salary attributable to routine duties, and then multiplies that number by the years required to bring a replacement up to the key employee's level of experience. Add to this the expenses associated with recruiting and hiring a new employee to determine the appropriate amount of key employee life insurance. Those are two ways of doing it. The most common way that I see this being done is to buy 5 to 10 times that employee's gross income. Most insurance companies will go up to 10x, 10 times that employee's earnings, but that's really the most common. If an employee makes $100,000 a year, many times the company will buy $1 million policy. And contribution to earnings method and the cost to replace experience method, both of those tend to actually work out very close to the 10x method of doing it. So let's talk about taxes for a bit. So when it comes to taxes, these premiums are not tax deductible. The business is the owner and is the beneficiary of the policy, and the business is using after-tax dollars to buy this life insurance contract. That's something that is beneficial because the proceeds that come to the business when that employee dies are actually excluded from the federal income tax when the notice and consent requirements, that piece of paper that the employee signed, have been met. So let's talk about this as though it were a permanent contract. If many times this ends up being a 10-year term insurance policy, sometimes a 20-year term that we see. But if it's a permanent policy, then there'll be some cash value in this contract. So if a key person doesn't die while they're employed, that business can use the cash value of the policy to meet other needs. The policy also it demonstrates financial stability to creditors, and or that cash value can use as collateral for a loan. Many times we talk about in our life insurance contracts, we can take a loan from a policy to pay something. But when it comes to IUL and whole life policies, banks love permanent life insurance from insurance carriers and will use those as collateral for loans at very good rates back to the company. For key employees who are owners, that policy could actually help fund a buyout of the deceased person's business interest. And then if the policy actually isn't needed after the years, again, this is for a permanent contract, if the policy isn't needed to protect the business, that cash value can be used to provide deferred compensation or retirement income to that key employee, or to another employee if you would like, but to that key employee. So key employee life insurance can serve a number of uses benefiting a business, both during that key employee's life and after the key employee's death. That's what we got on key person life insurance. Thanks for listening today. I'm Jeremy Hallett. If you've got any comments, please put them below. Smash that like, and I look forward to having a conversation with you the next time. Thank you.